Now, so far in this course, we have talked about the general concepts in accounting. We talked about the accounting cycle. That was the material for first exam. And then we discussed assets in general, right? So that was the second part of the course. It was about assets. We covered inventory, cash, receivables. We talked also about PB&E. Now we will start talking about the other part of the other side of the equation, which is first we start with liabilities, and then we will talk about stockholders' equity. Okay? So liabilities, basically, there are two types of liabilities, two categories of liabilities. What are these two categories of liabilities? Yes, current and long term. Thank you. Hey, it was here on the screen. See? You can see it. So you have current liabilities. What do we mean by current liabilities? Yes. That's correct. So current liabilities are the debts that the company expects to pay within 1 year or one operating cycle, whichever is longer. Remember that we said for certain companies, the operating cycle is longer than 1 year, such as like Boeing or Airbus. Those are the companies that manufacture airplanes, and it takes them a lot of time to do that and to sell it and to collect the money, etc. So the operating cycle is longer. But generally speaking, for most companies, the operating cycle is 1 year. Not the operating cycle, I'm sorry. The current liabilities are expected to be paid in 1 year because the operating cycle is shorter than that. Okay? And those include, so for current liabilities, those include short-term notes payable. Because there are also long-term notes payable. We will talk about that soon. Short-term notes payable are the notes, those are the promissory notes that are expected to be paid within 1 year. Okay? Now remember one thing. We already studied notes receivable, right? This is the other side of the story. So company A's note receivable will be company B's note payable. If you remember, we said when we studied notes receivable, we talked about the maker of the note and the payee, right? The maker of the note is the company or the entity that is making the promise to pay. To them, it is a note payable. They are promising to pay. So to them, it's not payable. To the company who is receiving that payment later on, the payee, it will be notes receivable. They are going to receive the payment. Okay? Now, there are other types of short-term, basically, of notes payable. Those are long-term notes payable. Think about them as the mortgage payments. So for example, mortgage payments for houses, those are long-term notes payable. So we'll start soon talking about notes payable and then the short-term notes payable. Those are the current liabilities. You have also sales taxes payable. Those are taxes that the company will collect when you make purchases. The company will not actually recognize that as revenue because they are not earning that money to themselves. They are simply collecting that money and giving it later on to the tax agencies. Okay? We also have payroll and payroll taxes payable. Those are the amounts that the company will have to pay, salaries and wages payable, etc. In addition to certain payroll taxes. Now, we also have unearned revenues. Remember those unearned revenues? This is when the company receives cash in advance. The company will receive cash in advance to make payments, to provide a certain service later on. This is one kind of deferrals. Remember those? That was a long time ago, ages ago, right? No, don't know. It was not ages ago. It was like a month and a half ago, or even we studied that in chapter 3, I think. So that was not ages ago. That was not too long ago. However, I'm pretty sure that you forgot everything about it, so we will remind you today. Yes, you probably forgot about that. I don't know why. You hate accounting. But that's okay. I forgive you for that. We also have current maturities. Remember current maturities of long-term debts. Those are debts that the company took for, let's say, I don't know, say 5 years. In the 5th year, they become automatically current liabilities because it's now that they will have to be paid. So, in the 1st year, 2nd year, etc., they were not current liabilities. They were long-term liabilities because they were to be paid after 1 year. However, when they start maturing, when they are near the due date, they automatically become current liabilities. Okay? Now, on the other hand, long-term liabilities, it's mostly bonds that people talk about. So this is long-term liabilities, bonds, and you have long-term notes paid. So let's start discussing that. Again, the current liability is the debt that the company expects to pay within 1 year or the operating cycle, whichever is longer. So that one is, we covered that one. Okay, I know I just gave the answer to this one. I just mentioned it a second ago, but let's do this. Oh, come on. I just gave you the answer right before I posted that one. I said it's 1 year or the operating cycle, whichever is longer. I literally said it this way. How disappointing. Frowning, okay, I'll give you a frowning face. So this is your frowning face. What? Sorry? Okay. At least that was something positive about it. Now, notes payable. Said from the beginning, I'm polite. If I hear someone talking, I will listen. This is what I do. If you talk, I will listen. If you want me to talk, you will have to listen, right? Makes sense. Now, notes payable. This is again the other side of the story of notes receivable. That's a promissory note. This is a note where the company promises to pay a certain amount after a certain period of time, basically at maturity, in addition to interest. So it will be the face value, that's the original amount, plus interest. Okay? Now, it could be for 3 months, it could be 6 months, it could be on a specific date. So all these can be usually are expressed or they are clearly mentioned on the note itself. We covered that when we talked about notes receivable. Now we're just doing the other side of the story. Now we are recording the notes from the maker's perspective. This is from the company who is promising to pay. So First National Bank agrees to lend $100,000 on September 1st, 2015. If the company signs $100,000, 12% 4-month note maturing on January 1st. So on September 1st, what happened on September 1st? No. The note was made, so the company signed the note, right? The company made the promise. So the journal entry in this case would be what? When the company signs the note, what would the bank do? It will give them $100,000 in cash. Thank you. So cash will be debited, $100,000, and notes payable will be credited $100,000. This is always at face value. Always. Notes payable like notes receivable, always at face value. Companies will not mix note receivable, the note payable with interest payable. In the same way that we learned before, notes receivable will not be mixed with interest receivable. Those are two different things. One of them is where you're giving a loan and you're getting back your money. Interest will be more of revenue. This is why it will be different. So interest will be later on once it starts accruing. So far, the company only received cash and signed the paper. No interest has accrued yet. Now on December 31st, what will happen? Sorry? You earn, no, you're not earning. This is the company who's making the payment. So you actually incur the expense. So it is the other company, the bank will record the revenue, you will have to record the expense. So remember, one company's revenue is another company's expense. One company's receivable is another company's payable. So in this case, for the bank, it will be a revenue. The company will record the interest expense, right? So, interest payable. Why is that? Because the company will not make the payment on December 31st. When will the company make the payment? January 1st. So if the company is preparing the financial statements on December 31st, the company will still have to recognize the expense to match the expense with the revenues of that period. However, the company will not make the payment. It will be a debt. It will be a new liability that the company will record as interest payable. So remember that when the company signs the note, they will receive cash, so that they will debit cash and credit notes payable. If the maturity date is after the preparation of the financial statement, the company will have to recognize the interest expense during that time, but because they will not pay it, it will be credited to interest payable. That's again, this is also a current liability. Okay, the amount of interest is always calculated in the same way. You multiply face value by the annual rate and then the partial year. This is what we've done so far. You multiply the financial, you multiply the annual rate by face value. That will give you the annual interest expense. If you had then 4 months, you multiply 4 over 12. If you had 8 months, it will be 8 over 12. Number of months over 12. Now, number of months until the date of the preparation. Don't mix the date of preparation with the terms. So, if for example that one, if it were to mature, so if it were instead of signing it on September 1st, it was actually signed on October 1st. How many months you would have? 3. Not 4. Although the terms of the note are 4 months, the company will only recognize until the day of the preparation of the statements. Now, on maturity date, the company will have to pay 2 amounts. The face value, that's the original loan, plus interest. All the interest will be paid at that time. So, at maturity, that's on January 1st, the company will debit the liabilities. You want to decrease liabilities. Again, what happens? The company is going to pay in cash the full amount plus, it's the face value plus interest that has basically plus the interest that they have recognized already. There will be no interest expense. The company already recorded the expense. Now, they are going to pay their debt. They have 2 debts at this point. Notes payable, it's always at 100, it's always at face value. We have also interest payable. Cash will be, both will be the 2 amounts. Any questions? Do you have any questions about this? So we have, when you're actually accounting for notes payable, you have when the note is signed, we debit cash, credit, notes, payable. This is when you are actually recording the new liability and the receipt of cash. Later on, if the maturity date is after preparation, you have to recognize the expense. At that time, you recognize the expense by debiting interest expense, crediting interest payable, because the company will not pay until maturity. On maturity date, it's always going to be cash, cash will be credited, face value plus interest. You also have notes payable will be debited, face value, interest payable will be debited, the interest value. Okay? Let's do this one. There was no need to have to answer, but it's fine. I mean, what's A and what's B and what's C and what's D? I have no idea. Now, so the company, they borrowed $82,600 on July 1st. So the amount, that's the face value, right? The borrowed amount is the face value. That's the date it was signed. By signing $82,600, 10%, that's the rate. That's the annual rate. 1 year, note payable. So we have 12 months. Okay? Prepare the journal entry to record the proceeds of the note. This is when the company actually signs the note. What do? You always debit, because the company will be receiving the borrowed amount. So they debit cash, $82,600, and they record the new debt, note payable, $82,600. So that's the new note that they signed. No interest is involved at this point. Now, assuming that the company prepares adjusting entries at the end of the year, we need to actually record interest that has accumulated until that time. When will the company have to make the payment? Next year. That will be end of June, right? So end of June, the company will have to pay face value plus all the interest that has accumulated for 1 year. But at the end of the year, the company will have to recognize interest that has accumulated from the day the company signed the note until the day the company is preparing the financial statement. So it's from July through December. How many months? 6 months. So what's the amount? The amount will be 82,000. It will be 82,600 multiplied by 10%, multiplied by 6/12. Okay? How much is that? Use the form. Sorry? 41,000? So it's 4,130. It's 10%. You have the 10% here. Okay? So the company will be debiting, will be recognizing the interest expense. So we debit interest expense, we credit interest payable. Any questions about that? Okay. Now we get to sales taxes payable. So sales taxes, sales taxes payable are what you pay when you go, for example, and purchase certain stuff from, let's say if you go to Best Buy, they will tell you that the price of this laptop is $500, but when you go to actually pay, it will be $500 plus tax, right? So it's always 500 plus tax, something like that plus tax. Actually, it depends on the city and on the county, and it depends on the state, the amount of tax that you will be paying. It's even in New Jersey. So generally speaking, in New Jersey, what's the tax rate? 7%. However, in certain cases, it's much less than that. Like for example, in Jersey City, it's 3%. So you have certain areas, certain counties. There are certain stores who will charge you. But not, I'm sorry. When you have certain counties who will charge you, or municipalities who will charge you 3%. So it depends on the location. Now, if you go and buy something from Walmart, actually you don't pay taxes for everything. There are certain stuff that are exempt from taxes. Those are the essentials. I'm not going to go into detail about tax because those of you who will become accounting majors, they will take a whole course about taxes. But for example, you as students, when you go and you buy lunch, for example, from the diner, they will not charge you taxes. Have you noticed that? They don't charge you taxes. When I go there, they charge me taxes. So that I will have to pay those 7%. So it depends on, again, on various things. Now the company, when they make a sale, they do not include taxes into their revenues because they are not earning the money. That money is not paid for them. Although you are paying the company, let's say when you go and buy something from Best Buy, you pay the $500 plus 7%. However, the 7%, the company will simply will be like a channel. They will take the money and give it immediately, not necessarily immediately, and give it directly to the tax agency. It's not immediate. This is why they recognize sales tax payable, because the company will keep them, but they owe that money, so they're not going to record it. It's not an expense. The company is simply acting as a collecting agent. It's nothing more than that. Okay? Generally speaking, companies would, when they ring up the sale, they will have the sale amount, and then they will also ring up the taxes separately. Sometimes they do it combined. I will learn how to calculate it in this case. But generally speaking, they will have it separate to basically make sure that this is sales revenue, and those are the taxes. Sales revenues are the companies. Taxes, the sales taxes, they will have to go to the tax agencies. Now, for example, March 25 cash register reading for Cooley Groceries shows sales of 10,000 and sales taxes of 600. That's 6% of that 6% tax rate. The journal entry will be what? How much would the company actually receive? Yes? 10,600. So the company will debit cash 10,600. That's how much the customers will actually pay. Now, out of these 10,600, the company's revenue is 10,000. So the company will credit sales revenue 10,000. The 600 is credited to the liability, sales tax payable, because this is the amount that the company will have to remit later on or to send later on to the tax agencies. Okay? Any questions? Okay. So when the company actually makes the payment to the tax agency, what happens? The company will pay in cash. So cash will be credited, how much? 600. So the company will be credited. The company will debit the liability, sales tax is payable, 600, and they will credit cash 600. In this case, they don't owe the tax agencies any more money. However, the cash has decreased. This is why it's not an expense. It's not something that the company has incurred. It's simply the company is taking that money and sending it over to the tax agencies. Any questions? Yes?
So that 600 is basically from that like taxes that they made on the sale?
You cannot say made. Made on the sale, it means that they earned it or something like that. This is the tax that were charged to the customer.
Yeah.
So this is when you go to Best Buy and you buy something for, let's say you buy some stuff for $1,000, they will charge you 7%. That 7%, instead of you going to tax agency and making the payment yourself, the company will basically think about it as if the company is doing you a favor. The company is taking the money from you, and they will also take it from Cliff, and they will also take it from Farah, and they will take and will put them all, will send them all together to the tax agency. So the company did not actually make the money, they did not earn it, they are simply collecting it. However, who actually paid those 600? It's the customer. Okay? Now, like we said, sometimes the companies, like instead of basically recording the revenue and the taxes separately, they will have just one final amount, which is 10,600. That's the total. When you have the total, this is what you need to do. You have to separate, basically you have to understand which part is the revenue, which part is the taxes. So let's see how we calculate it. This is the total amount, okay? It's equal to what? Okay, it's equal to 10,600, but what are the two components here? Sales and? Exactly, so you have sales, revenue plus tax, right? So the sales revenue is 100% of the sales plus we have 6%. 6% of the sales. Right? Any questions so far? So that will be equal to 106% of the sales, which is equal to 1.06 multiplied by sales. So in this case, we said this is 10,600. So the sales are equal to 10,600 divided by 1.06. That's 10,000. That's sales. Now we have one of two ways of calculating tax. You can either multiply it by 6%, that will give you 600, or you can do it like this. You have the total minus revenue, that will give you 600. Any questions? So this is how you do that. You have to basically divide, you have to actually get to the sales, and then from that amount, just multiply it by the tax rate. Any questions about that? The journal entry, in this case, it will be cash will be debited 10,600. And then we have sales revenue 10,000 and sales tax payable will be 600. So this is basically the same thing. However, it's simply you have to calculate the two amounts. So in the previous slide, they gave us the two components and we had to calculate the total for cash. And this one, they gave us the total and the tax rate, and we had to basically calculate the two components. Any questions about this? Okay, so let's do this one. Okay, so the correct answer is actually 6,000. Now, how do you calculate this? Once again, they give us the total amount. So the total receipts is 126,000. They did not bring them separately. So we have to calculate the two components. They gave you the total and the rates. You have to calculate sales revenue. In this case, this is what they are asking you. What's the amount of sales taxes? Once you have the sales revenue, you can multiply it by the rate and you get the sales taxes. So we have the total we have here. Total is equal to sales plus tax. Okay? When you have total is equal to sales plus tax, what's the amount of so sales, this is, let's call 100% sales plus 5% sales. Okay? That's equal to 105% sales. This is equal to 126,000. So sales is equal to 126, so this is equal to 1.05. 105 is equal to 1.05. That's just simply dividing 105 by 100. So it's 1.5 multiplied by sales. So sales is equal to 126,000 divided by 1.05. That's equal to 120,000. Multiply this by 5%, it will be equal to 6,000. That says tax. Any questions? Okay. So in this case, I believe many of you just multiply 5% by the total. You have to be careful about this. When they tell you that this is the total, tax is already included in it. So you do not apply the tax rate to that total amount. You apply the tax rate always. You apply it to the sales itself, not to the total. Okay? Any questions? So basically, this concludes notes payable and sales tax payable. Now we'll talk about payroll and payroll tax payable. I'm not going again to go into detail about that. When we talk about payroll, we're talking about salaries and wages. Basically, the main difference in salaries and wages is that it's the way they are basically paid. The employees are paid. So, for example, for salaries are when you talk about monthly or yearly salary. Wages are mostly for when the employee is paid on an hourly basis. From an accounting perspective, it's the same thing. And as you remember, we used to have salaries and wages payable, salaries and wages expense. There are different factors that we need to take into consideration when we're talking about payroll. We need to look at the gross earnings. This is the actual expense. And then you also have payroll deductions. That's the second part. The last part would be the net pay. The net pay is whatever the employee actually gets. Okay? So in many cases, well, it's not a nice feeling, trust me. So imagine that, for example, think about it this way. You go to the exam, you do very well, you get 90 on the exam, and then I tell you that there is a tax on the exam. Now you only get 70. How would you feel? It's in the same way. So you make a certain amount, that's the gross earnings. And then you start seeing deductions. And this is where you can actually start seeing a lot of amounts that are deducted or removed from your paycheck. So, yes, look at her face. How many of you watch Friends, the sitcom? Okay. Do you remember the episode where Rachel received her first paycheck? She was very happy at the beginning. So this is Rachel. She was very happy at the beginning when she received the paycheck. And then she looked at it and said, who's this FICA guy who's taking all my money? So this is Rachel after she looked at the net amount. This is my face as well, without the long hair. So this is my face also whenever I also get the net pay. So the salary, basically the gross earning. are much, much higher. So the gross pay will always be higher. Then you start having those deductions. Some of them will have to go to the state. So you have to pay, for example, state and city income taxes. You have to also, some amount are also deducted for the federal income tax. You have FICA, which is basically Social Security. So you have to pay for Social Security as well. There are different payments that start getting deducted one after the other. And then at the end, you end up with a much smaller net pay. This is the actual check that you will receive from the company. That's for any kind of job, basically. This is whenever you are employed, you start, you basically, whatever your salary is on the papers, that's not what you will receive. So if you are going to plan your budget, do not plan your budget based on your gross pay, based on your salary. Otherwise, you will be in debt your whole life. You have to plan it based on your net pay, unfortunately. See, the $100, I don't like it anymore. It looks ugly now. All these parts that were taken off of it. Just whenever you forget about that, remember Rachel, what she did. What did she do? When she didn't like that one, what did she do? She eventually looked for another job. That's the only way to basically avoid that. Now, so those tax payables, they are deducted from the paycheck of each employee. This is not the amount. Here we're not talking about what the company is paying themselves. You see, the company's expense, let's say in this example, the expense is 100,000. So that's the gross pay. It's 100,000. This is how much the company will actually end up paying. That's the gross pay. You have salaries and wages expense is 100,000. What the employees will receive, the checks that the employees will receive are salaries and wages payable. Those are the actual amounts that will be paid by the employees, or will be paid to the employees. Okay? Those ones are withheld. So those are different taxes that are withheld and payroll amounts that are withheld. The company will keep them, and then they will send them to the appropriate agencies. Okay? So for example, you have those Social Security will be sent, basically you have paid for that as employee, not the company. So this is basically you have the gross pay. This is the net pay. Those are withheld. Later on they are sent. This is why they are payable as far as the company is concerned. The company will not send them now, however the company will have to pay them to those agencies, to the state and to the city and to Social Security, etc. Okay? Now, this is when the company is preparing and recording their payroll. The company will send the payment. How do they record it? They will send out the checks for which amount? Sorry? Salaries and wages payable. So the company will do what? Will debit salaries and wages payable and credit cash. Remember, when checks are sent, checks are considered what? Cash. This is what we learned before. Sometimes it's checks, sometimes it's wire transfers. The important thing is that those are paid in cash. So cash will be credited, that amount, the net pay. Now, in addition to those amounts, the company itself will have to contribute to and will have to pay certain taxes. This is what you call payroll tax expense. That's an expense now. This is an amount that the company has to pay themselves. So the company, to record it, what they will do, basically they will have, why do they record it? They will have to, for example, the company also will have to contribute to Social Security and to unemployment, both at the federal level and the state level. So the company, in order to record that, they will debit payroll taxes. Basically, they will debit payroll taxes expense, and and they will credit the individual expenses. So they will have Social Security, they will have also unemployment at the state and federal level. We're not going to learn in this course, we're not going to learn how to calculate those amounts, how to do this or that. We're not. Here we simply need, what you need to understand is that the company will be actually contributing to Social Security, that's FICA, taxes payable, and they will also be contributing to unemployment, basically state unemployment and federal unemployment. Okay? That's all I need from you to know about this. Okay, I just answered this one. Do not disappoint me. Which one the company, this is the employer, which ones they will not be included in the payroll taxes? Again, those are not the deductions, those are the employers' payroll taxes. Okay, so that is the majority. That at least we got the majority of all got it right. So this one actually concludes with payroll taxes. Okay? Now we get to unearned revenues. Unearned revenues, as you guys probably do not remember, those are the liabilities that the company, where the company receives cash payments before they actually provide the service or make the sale. This is when you buy an airline ticket before you fly. The airline company now owes you that flight, right? They don't owe you money, they owe you a flight. When you buy tickets for like season tickets, those are also like from Rutgers. Rutgers will actually owe you those games. They don't owe you money, they owe you those games. Okay, we're not talking about returns and stuff like that. That's a different thing. We're talking about what they owe you at this point. If you don't return them, they owe you those games. So until they actually start providing that service, which is they play those games, they still owe you that liability. Okay? Same thing applies if you remember to, for example, for example, magazines, subscriptions. If you subscribe to the magazine, you pay in advance for 12 volumes, for example, they owe you the amount for 12 volumes. Every time they send you one, they would have earned the money for that specific volume, right? So in this case, you would have, for example, it would start with unearned revenue. So it would be, for example, unearned ticket revenue. Okay, this is when you receive cash, you will be debiting cash, and you basically, this is, you debit cash, you credit the liability. That's when you actually receive cash first. When you provide a service, you start saying that, okay, so this service that I did not earn, I earned part of it. So you recognize the part that you already earned. In this case, what do? You debit the liability, and you credit the actual revenue. So there are two steps. First time is when the company receives cash, and they record the liability, because they have not earned it yet. And then when they start earning it, they record whatever they earned, whatever revenue they earned, and they also record the decrease in their liability. So for example, Rutgers University sells 10,000 season football tickets at $50 each for its 5-game home schedule. The entry for the sale of season tickets is, how much did the company receive in cash? But, yes? 10,000 times 50, which is 500,000. This is 10,000 multiplied by $50. Okay? So that's 500,000. Did the company earn any of it? Not yet. So this is a liability. Here we credit unearned ticket revenue. After every game, so after the first game, for example, so after every game, the company would have earned one game. That's 1/5 of the amount. So the company will be crediting ticket revenue 1/5 of the amount, which is 100,000, and they will be debiting the liability. They will be decreasing their liability, which was unearned ticket revenue. So you debit unearned ticket revenue and you credit the revenue account. What you're saying basically in plain English, those $500,000 that I owed for, basically that's where I owed 5 games, I haven't earned any of it yet. After every game, the company would have earned one game, which is 1/5, that will be $100,000. That's what you're basically saying. Whatever I did not earn it at the beginning, I started earning it now. So what you owe, what the company owes, the customer or like the other party, will be down by 1 game. Now you don't owe them 5 games, you owe them 4 games. After the second game, it will be 3 games that you owe them. Any questions about this? Okay, to encourage you, I'm going to give you a smiley face. You cannot say that this was cute. That's better. Now, this is a typical problem again. So they are selling those they are selling the subscriptions on annual basis. They publish 6 times a year, so they have 6 times a year. They owe 6 volumes. Okay, the magazine sells 660,000 subscription at $15 each. What entry is made in January to record the sale of the subscriptions? The company will simply receive cash how much? They will receive 60,000 multiplied by $15. That's 900,000 in cash. So cash will be debited 900,000. On the other hand, the company has not started, the magazine has not started actually delivering those, basically those volumes or anything like that, those issues. So instead of earning that money, they have a liability now. They have to deliver 6 issues. That would be the same amount as unearned subscription revenue. Any questions about this? Okay. We get to current maturities of long-term debts. So those are debts that the company used to owe for more than 1 year. However, they are getting closer to their maturity, and their maturity date is within 1 year. As a result, they become current liabilities. So the company has to pay them now. Okay? Now the company does not make an adjusting entry for this. You don't need to make an adjusting entry. What you're simply making is that the way when you present it, or where you classify it on the balance sheet, for example, you classify the part that is maturing soon, you classify it as current liability. You add it to the current liabilities. Okay? So for example, Wendy Construction issued a 5-year interest-bearing $25,000 note on January 1st. This note specifies that each January 1st, starting January 1st, 2015, Wendy should pay $5,000 of the note. So this is more like what? This is a long-term note payable, right? Which is more or less like the mortgages. This is where you pay actually an installment, you pay a monthly installment or a yearly installment or something like that. In this case, the note specifies the terms of payments. And the note specifies that every January, the company will have to pay 5,000. So instead of waiting until the end of the 5 years, the company wants to receive, the bank, for example, they would want to receive a certain amount every year. Sorry. Okay? So every year, the company will have to make $5,000 payments. Okay? So the first payment, is it current or long term? It will be due within 1 year. So will it be current or long term? Current. What about the other 4 payments? You have a total of 5 payments, right? What about the 5 other payments? The 4 other payments, they are long term. So the company will not make an adjusting entry here. What they will make is the amount that should be reported as current liability is 5,000, the other is 20,000. They will simply classify it differently. Okay? When they make the payment, their notes payable will decrease, their debt will decrease. However, they will still have one part that will be current, the remaining part will be long term. In the financial statement, on the balance sheet, companies usually, when they record current liabilities, they usually start with notes payable because it has the strongest claim over the company's assets. So they start with notes payable, and then they have, again, we're talking about short-term notes payable here because we're talking about the current liabilities. So notes payable first, accounts payable next, and then in order of magnitude. Now that's not like a rule. This is more of a guideline. So this is like practice. In practice companies, they do that. They usually sort them in order of magnitude, basically in decreasing order. Doesn't mean that it has to be that way for every company. Okay? This is simply, the important thing is that this information has to be disclosed the way they present it. It's up to them. It's like filing certain documents. You can file them according to the number, or according to the vendor, according to the date, in alphabetical order, so it depends on how you want to do it. This is generally what companies do. They start with notes payable, accounts payable, and then in order of magnitude. Okay? As you can see here at the bottom, you have also long-term debt. So long-term debt due within 1 year. This is the same thing as current maturities of long-term debts. Any questions? Okay. Now, if you remember, we talked about companies' liquidity before. This is basically to see the company, the creditors and investors, they look at the company's ability to pay short-term debts. Basically, if they can meet their short-term obligations. If the company needs to pay within 1 year $1 million, that's current liabilities, they should have current assets that are at least $1 million. They should be able to meet their obligations, otherwise they will be in deep trouble, right? They will not be able to meet their obligations. So companies, they would either look at the ratio or at the difference. So if they look at the difference between current assets and current liabilities, that's the difference, that would give you the working capital. Now the working capital is basically whatever remains basically from the company's current assets after they have, after the company has made sure that they have, after they say that they calculate what they need to pay, or they put aside what they need to pay for this upcoming year, for the current liabilities. Now the problem with the working capital is simply that it can be misleading. So if you have a working capital of $10 million, you cannot say if this is good or bad, because that will depend on the size of the company itself, and it will depend also on the industry, on what the company is doing. So for example, a company like Apple or Google or Microsoft, if they have $10 million as working capital, that's not good. If you have a small company with $10 million as working capital, that's good. That's pretty good. This is why companies, they actually look at current ratio. Current ratio is simply where you divide current assets by current liabilities. Okay? Here you're saying that for every dollar of current liabilities, you have, in this example, for example, you have $1.43 in current assets. The higher the ratio, the better it is. Okay, generally speaking, companies, they used to think about that the ratio of 2 to 1 would be a good ratio. However, nowadays companies, they are making more a better use of their assets, a more efficient use of their assets, and when they report something lower than that, even when they report something lower than that, they will still be fine. Okay? So, working capital is current assets minus current liabilities. Current ratio is simply current assets divided by current liabilities. Any questions about this? Okay, so we are done with that part. Now we'll start with long-term liabilities. So we finished current liabilities. Long-term liabilities, as we mentioned, those are debts that will be due after 1 year. The most common type of it is bonds. Bonds, they have several advantages over issuing stock. So basically what you have, bonds are usually done when the company wants to raise capital. So if they want basically to get some funding, they say that they want to build a new manufacturing plant. They will need more money than a note payable can give them. They need something more formal. So companies might issue bonds. Bonds are basically, they are borrowing money from people. Okay? Bonds usually, they will also incur interest, which is most of the time paid semi-annually. Every 6 months there will be an interest payment. So when a company is trying to, usually when the company is trying to raise a large amount of funding, they will either issue stocks or they would issue bonds. Each one of them has advantages and disadvantages. We will learn about stocks later on in a different chapter. So, but generally speaking, bonds, they have certain advantages. Bonds, simply the company is borrowing the money. So they will have, the disadvantage is that they will have to pay back that money because they are borrowing it. Plus, they have to pay interest. If the company issues stocks, the company does not pay interest and does not have to pay back the money. It's basically part of the capital of the company. Okay? Now, bonds, on the other hand, you have, when the company actually issues bonds, it will not change the ownership of the company. So basically, if you as an investor, you have, let's say, 5% of the company, when the company issues bonds, you still own 5% of the company. If the company issues new stocks, the ownership will change because you have new investors. So your share in that company will decrease. Now, there's another thing. There's another advantage, which is taxes. Interest is basically, so the amount of interest that the company is paying, this will be tax deductible. On the other hand, with stocks, company will have to pay dividends. That's not tax deductible. So overall, while the company is actually taking a loan and paying interest, earnings per share will or might be higher than when the company issues stocks. So let's see, for example, this is a comparison between the two plans. Plan A, this is when the company issues stocks. Plan B, issuing bonds. When the company issues stocks, income before tax is the same. Before interest and tax is the same. 1,500,000. Stocks will not pay interest. On the other hand, let's say that the bonds would have to pay 400,000 interest. That's 8%. Okay? That significantly would lower income. So as you can see here, income before income tax, so this is income after paying interest. This is much higher. However, income tax, after paying income tax here, income tax will be higher, but at the end you have net income. Which one is higher? Which one is higher? Plan A or Plan B? Plan A, right? So by issuing stocks, you would end up with a higher net income. The problem now is that you have more shares. The number of shares here is 300,000, whereas here it is 100,000. So the amount of money, the net income, will be divided over 300,000 shares, compared to Plan B, where you are dividing that net income by only 100,000 shares. So in this case, you have a higher net income, but if you use Plan A. If you go with Plan B, you will have lower net income, however, you will have a higher earnings per share. Lauren?
Why? Like, where did you get those asset and share numbers?
The 300 here?
Yeah,
This is one we will explain it more in the next chapter. It's when we will talk about issuing stocks.
okay.
But basically, they will tell you that they issued 200,000 stocks. That's what will have the difference. It will change the number of outstanding stocks.
So it depends on just stocks. I mean, because stocks are.
This is why it's not always the same. This is why Plan A is also an option. So why sometimes otherwise companies will always issue bonds. But in certain cases, they say that if the number of stocks is not that high, maybe they can actually, instead of borrowing money, they simply invite new investors. So it depends on the stock price. If the stock price is high, the company will want to sell stocks. If the stock price is down at this point, then I doubt that they would want to basically wait for their stocks. Okay? Now there are different types of stocks. So you would have, for example, secured and unsecured bonds. I'm sorry, bonds, not stocks. Bonds. You would have different types of bonds, secured and unsecured. When you say secured, it's secured by a certain asset. So like mortgages, for example, okay? They are secured by certain assets. You have different cases where, for example, you would have, they say, if you buy a building, the bank, if you have a building and you want to borrow some money, the bank might ask you to have some kind of asset that is like placed as collateral. If you fail to pay your debt, then they will take that asset. This was what happens in many cases when you have, for example, foreclosures and stuff like that. Now, unsecured, they are also called debenture. Those are basically issued based on the company's, think about it, based on the company's reputation. So for example, if Apple asks for a loan, Apple is known to be a stable company, or if Sony, for example, they ask for a loan, they are a stable company, they are unlikely to default on the payment. Just because of their reputation, the bank might give them that, people might buy their bonds. Here, issuing bonds is when it's done when the amount that needs to be raised is too high to be borrowed from one entity. So the company cannot raise like millions of dollars from just one entity. It's very difficult. So they issue bonds. Each bond is like usually $1,000, and those are actually traded in the stock, basically on exchange markets. So you have municipal bonds, you have corporate bonds. All these bonds are traded. We'll see in a second how. But what you need to understand is that sometimes you will simply buy that bond because you know that this bond comes from Apple or from Microsoft or from Google or from Samsung or a certain company that the market has favored. Now, term and serial bonds. Term bonds are when they tell you that you have it will mature at a specific date. This is like when we said for the notes payable, it will mature in 5 years. Bond that will mature in 10 years, for example. You also have serial bonds, which will be like paid in installments. Again, like the previous example, when we saw that the company will have to make a $5,000 payment every year, this would be, for example, a serial case. Registered and bearer bonds. Registered bonds would have the name of the specific owner of that bond. Bearer bonds, or sometimes they also call them coupons, those are basically anyone who has them in their hand can basically sell them and can use them. They are not attached to a specific name, unlike registered bonds. Convertible and callable bonds. So convertible bonds are bonds that the owner of that bond, the owner of the bond is basically the person who is buying that bond, not the company who is issuing the bonds. So the person or the entity that is buying those bonds has the right to convert those bonds to stocks, to common stock. Okay? We will learn later on what happens and how this is actually done. The company will have to convert them to stocks. This is, for example, when the company is doing much better and the owner of the bond will say, okay, I don't want it to be a bond, now I want to become an investor. I don't just want to be a lender, I want to become an investor. They have the right to convert it if it is a convertible bond. You also have callable bonds, and nowadays most bonds are callable. Callable means that the company can call them back. They have the right to buy them back before maturity. So let's say that the company had a need for financing to build a new manufacturing plant. They issued bonds, they would be paying interest. However, let's say a few years later, like 2 years later, they start making a lot of money. They don't want to keep paying interest. So what they do is they have the right to buy back those bonds before they mature. Okay? This is what we call callable bonds. Okay. How do companies issue bonds? Issuing those bonds, usually both the board of directors and the stockholders, they have to approve the issuance of the bond. This is one of the major decisions that the company is making. They are borrowing money, large amounts of money, so they have to get the approval of the board of directors and stockholders. There will be a vote on it. Once they approve the issuing of those bonds, the board of directors will decide on the number, so basically the number of bonds, let's say 1 million bonds, the face value and the contractual interest rate. They look at the interest rate and they decide that this is the amount that we want to sell those bonds. So the face value, the number of bonds, and the contractual interest rate. So this is the interest rate on the bond itself. Okay? Generally speaking, the company will actually get authorization to issue, let's say, 1 million bonds. That does not mean that the company will actually issue the 1 million bonds. They might issue, for example, 700,000 bonds. They will keep 300,000 bonds so that in the future, if they wanted to raise more funding for certain project, they don't have to go through the process of getting approval again. So they keep that like for a rainy day. Okay? They will issue whatever they want now. Generally speaking, the authorized number is higher than what they actually need at this point. And in general, bond certificates are made for $1,000. Now, the document that specifies or explains what these bonds are, what the bond terms are, is called bond indenture. Okay? Again, the bond represents basically it will be paid back in totality on maturity date. In general, the interest rate will be paid semi-annually. That's in general how companies do it. Every 6 months, there will be a payment of interest. Okay? So, anyways, will be